Are we looking at a market caught in a falling trend with flashing sell signals? Or is this a strong buy that some folks still stubbornly call undervalued? I mean, that is the million-dollar question today.
It really is the debate right now.
Yeah. Our target today is an absolute heavyweight in the financial world. We are looking at the iShares iBoxx high-yield corporate bond ETF. And if you watch the markets, you definitely know it by its ticker symbol, HYG.
Right, HYG.
But before we rip into all this data, do us a really quick favor. Please like this video, subscribe to our YouTube channel, and you absolutely have to leave your comments and feedback below. It genuinely fuels these deep dives.
Oh, it's the engine that keeps us going. We read all of it. And, you know, HYG is the perfect target right now because it's sitting squarely at this really weird intersection of corporate health and, well, severe macroeconomic anxiety.
Totally. So our mission today is to look directly under the hood of HYG. We are breaking down its latest market. Quote, the technical indicators that are kind of fighting each other on the charts right now, the fierce bull versus bear case, and the real risks lurking beneath what is, frankly, a very attractive yield.
And just to jump in before we get too deep, remember, for everyone listening, we are here to debate the mechanics of this fund and explore the research. This is just a natural human debate. It is not personal financial advice.
Definitely not. Please don't go clicking buy just because we like a specific chart setup.
Right, we're just dissecting the anatomy of this ETF so you can understand the hidden levers driving it.
Okay, let's unpack this. Looking at the fund metrics, I mean, the sheer gravity of HYG is staggering to ground this conversation. We are talking about $17 billion in assets under management.
It's a massive pool of capital.
It is. And it charges an expense ratio of roughly 0.5%, 0.49% to be exact, to manage all that money. As of today, April 14th, 2026, it's trading right around $80.50, showing this really minor daily gain of about 0.30%.
Yeah, and the day's trading range has been incredibly tight. I mean, barely moving 25 cents in either direction. It's hovering between $80.29 and $80.56.
Which feels like it's just stuck in mud.
It does. That suffocatingly tight daily range is characteristic of a market that is just holding its breath. But to understand the psychology of the traders right now, you get to zoom out to the 52-week view.
Right.
The 52-week high sits just north of $81.36 to be exact, which we hit back in September of 2025. And the low was almost exactly 1 year ago today, down around $76.94.
So we are sitting dangerously close to the very top of that 52-week range. I mean, buying at the top always makes people sweat a bit.
Oh, absolutely.
But the magnet pulling all that $17 billion in isn't necessarily the hope that the price goes up to, like, $90. It's the income.
It's always the income with this fund.
Yeah. The trailing 12-month dividend yield is hovering around 5.84%. But if you look at the 30-day SEC yield as of April 10, it's pushing nearly 6.68%.
Which is huge.
And it pays out monthly. The latest distribution was almost 39 cents a share, 0.3837 just a week ago on April 7. I can immediately see why people gravitate toward this. Getting a 6.68% annualized yield paid out every 30 days is, well, it's a powerful psychological comfort blanket for an income investor.
It completely changes the entire calculus of how you view your portfolio. When you get cash deposited into your account every single month, it's very easy to ignore the underlying price chart.
Right, because you're just looking at the cash hitting your account.
Exactly. But let's look at the actual order flow, because the plumbing of the market tells a very compelling story right now. Talk about who's buying and selling. Today, we saw about 7.55 million shares traded.
Which sounds like a lot until you look at the 3-month average, which sits way up at nearly 54 million shares a day. I mean, volume has completely fallen off a cliff today.
It has. But despite that massive drop in volume, recent order flow suggests neutral to positive demand. The fund is actually recovering from a minor dip we saw in early April.
Okay, so people are still buying.
Yeah, and you have to contextualize this within the broader environment. Active ETFs saw a staggering $475 billion in inflows in early 2026.
Wow.
And iShares is absolutely dominating that market share. There is just this massive wave of capital seeking shelter and yield right now.
But let's be real about what that capital is actually buying. Calling it a high-yield corporate bond makes it sound prestigious, like it's totally secure. We need to remember what's inside the wrapper.
Always look inside the wrapper.
Right. The fund holds approximately 1,300 individual high-yield corporate bonds. You aren't picking one winning horse here. You're buying a stable of 1,300 horses and just praying the racetrack itself doesn't collapse.
That is exactly what it is.
So, looking at the volume again, dropping from 54 million down to 7.5 million while the price stays stable. To me, that doesn't scream aggressive buying. That sounds like a standoff. Are the institutional buyers quietly accumulating, or are they just holding their breath?
Well, a drop in volume while price remains stable usually indicates seller exhaustion. The investors who bought in strictly to capture that early April dividend have already made their moves.
Right.
The people currently holding the ETF are perfectly content to sit on their hands, collect their yield, and wait for clearer macroeconomic signals. Since we know where the price is right now, I think we should look at where the momentum is actually pushing it. Let's move directly into the technical analysis.
Well, definitely. Let's pull apart the momentum here because there is a serious war happening on the charts.
There really is. If you look at the short-term indicators, the trend direction is actually your friend. It's bullish.
Okay.
At our current price of $80.50, HYG is sitting above its 5-day moving average of roughly $79.98. It's also above its 20-day moving average at $79.47.
And crucially, it's sitting above its 50-day moving average, which is right around $80.14.
Right. Being above that 50-day moving average is vital. In technical trading, the 50-day acts as this psychological benefit of the doubt zone. When an asset trades above it, the market assumes the underlying momentum is bullish. The buyers are successfully defending every minor dip.
But there is a massive heavy ceiling right above their heads.
Yes.
The resistance, that 200-day moving average, isn't just a line on a chart, it's a psychological brick wall. And HYG is trading right at it. The 200-day resistance sits at $80.51. The price today is $80.50. Yeah. It is literally bumping its head against that long-term ceiling for a single penny as we speak.
That 200-day moving average is often considered the ultimate line in the sand by institutional traders. When a price approaches it from underneath, it encounters immense selling pressure.
Because everyone who bought a year ago is finally back to break even.
Exactly. Think about the mechanics of it. Anyone who bought near the highs over the last year and watched the price drop has been waiting months just to get their money back. When the price finally reaches their break-even point, they sell to escape. That creates a natural, heavy resistance.
And if that wall holds and the price gets rejected, the floor isn't too far below. The first key support level to watch is roughly $79.32, which was the floor we hit back on April 7.
Right.
If the selling pressure breaks that, the next major safety net is around $78.57, the 30-day low. On the flip side, if the buyers somehow smash through this 200-day ceiling, the next real major resistance is the 52-week high of near $81.36.
So the price is completely squeezed right now. It's trapped between the upward push of those short-term moving averages acting as support and the hard, unrelenting ceiling of the 200-day average.
Here's where it gets really interesting to me. I mean, despite being above the short-term averages, algorithmic indicators currently list HYG merely as a hold candidate.
Not a buy.
Not a buy. By traditional definitions, being above the 5, 20, and 50-day is textbook bullish momentum. But the algorithms are stubborn here, so I have to ask, if the momentum is bullish but it's bumping its head so hard on the 200-day ceiling, is this short-term strength actually a warning sign of exhaustion?
Well, momentum isn't just about the direction a price is moving, it's about the velocity and the room left to run. The algorithms recognize that buying an asset literally 1 cent below a massive 200-day resistance line is just a mathematically poor risk-to-reward setup.
You're risking a drop back to the $78 range just to squeeze out maybe 50 cents of upside.
Exactly. And this technical ceiling naturally introduces the whole debate over how human analysts are rating the fund right now. Nobody wants to be the one who issues a strong buy at the absolute peak of a resistance level.
Right.
If you look at the major institutional platforms, almost all of them maintain a rigid neutral rating. Which brings us right into the core debate. Is this ETF genuinely undervalued right now, or is it a classic value trap?
Let's get into the trap argument first, because analysts categorize it as a hold for exactly that reason. The valuation is sitting near the very top of its 52-week range. Buying now means you might just be catching the top of the market.
Yeah, the trap springs when a slight economic headwind hits, the principal price tumbles, and suddenly that yield doesn't come close to covering the capital you just lost.
But on the flip side, looking at the undervalued argument in our sources, there are solid points. The credit fundamentals among these 1,300 corporations are actually remaining quite stable. And we have softening interest rate expectations. When the market expects interest rates to cool down, bond prices inherently rise. So you combine softening rates with a 6.68% SEC yield, and suddenly buying at $80 doesn't seem like stepping into a trap at all. It seems like a highly attractive defensive play.
If we connect this to the bigger picture, the trap depends entirely on your specific strategy as an investor. I mean, are you chasing capital appreciation?
Where the upside seems totally capped.
Right. If you want the price to shoot up to $90, you're playing the wrong game. But if you are buying it strictly for the monthly income buffer, then it is functioning exactly as it was designed to function.
But to figure out if it's really a trap, we have to look at what could actually cause the bottom to fall out. We need to get into the downside risks and the volatility here.
Let's do it.
Let's say the quiet part out loud again. High yield is just polite Wall Street branding for junk bonds.
It absolutely is.
And the entire bear case for HYG hinges on default risks. If economic growth stalls, those 1,300 companies might really struggle to pay their debts.
We're talking about companies that carry lower credit ratings. These aren't cash-rich tech giants. These are often highly leveraged businesses. And that's why HYG's performance is highly sensitive to the macroeconomy.
Like unemployment.
Exactly. Our sources highlight two massive economic pillars: the unemployment rate and GDP growth. Think about the causality here. If unemployment spikes, consumer debt capacity evaporates. People lose their jobs, and they immediately stop buying goods and services from these exact 1,300 lower-rated companies.
Their revenues shrink instantly.
Right. And if GDP growth stalls alongside that, refinancing debt becomes nearly impossible. A company defaults when it hits a maturity wall, needs to roll over old debt into new debt at today's higher interest rates, and the lenders say no. That is what craters the price of a junk bond ETF.
And there's also inflation to worry about. Periods of high inflation actively erode the fixed income returns of a fund like this. Which brings me to why retail traders specifically get trapped here.
The retail trap.
Yeah. Everyday folks open their brokerage apps, they sort by highest dividend yield, they see that 6.68% on HYG, and they buy blindly without looking at the total return.
The total return metric is the ultimate reality check. It combines the dividend payouts with the actual price movement.
Exactly. And the data shows HYG significantly underperformed the S&P 500 in 2025. Retail investors buy purely for that monthly dopamine hit of the dividend payout, but they lose big on capital depreciation if those macro factors turn sour.
Right.
Imagine holding this for a year. You collect $5 in dividends per share, but the share price drops by $10 because unemployment ticked up. Your total return is deeply negative. You literally chased a yield right off a cliff.
Ignoring the price chart to focus solely on the yield is the most common error in fixed income investing.
So we've painted a fairly grim picture of the worst-case scenario. Let's balance the scales. Outline the best-case recovery scenario for us. The bull case.
The bull case is remarkably resilient right now, and it relies heavily on the concept of narrowing credit spreads.
Meaning investors feel confident, so they demand less of a risk premium to hold junk bonds.
You nailed it.
Yeah.
As that spread narrows, the price of the corporate bonds inside HYG goes up. But the other massive part of the bull case is the fund's short duration. The weighted average maturity of the bonds in this fund is only 3.62 years.
Which acts like a shock absorber.
A massive shock absorber. A duration of 3.6 years means that if interest rates were to suddenly rise by 1%, the value of the bonds would only drop by roughly 3.6%.
Compared to a long-term treasury fund that might drop 15 or 20% on that same rate hike.
Exactly. It's highly insulated against wild interest rate shocks.
And we also have to look at external catalysts that feed into those rate expectations. When we look at the geopolitical data in the sources, and just to be completely 100% clear here, both of us are looking at this strictly through the lens of market data. We are taking no political sides regarding foreign policy. We are just explaining the market reaction.
Absolutely. We're just looking at how the market reacted to the news.
Right. So the numbers show the recent U.S.-Iran ceasefire had an immediate, measurable impact on these funds. It temporarily eased rate hike fears.
Geopolitics and bond markets are deeply intertwined. Geopolitical conflicts trigger fears of oil supply shocks, which drive inflation, which forces central banks to raise rates.
So the ceasefire acted as a global relief valve.
Yes. The market interpreted it as a stabilizer for oil, cooling inflation fears, and directly benefiting financial instruments like HYG. It provided a very timely tailwind.
Okay, so we have the bull and bear cases clearly drawn. Let's synthesize this into a final outlook. Short-term versus long-term.
In the short term, the outlook remains neutral to bullish. We have stable corporate credit at this exact moment and softening rate expectations.
Despite bumping its head on that 200-day moving average.
Right. But the long-term perspective is entirely dependent on macro survival, specifically inflation and unemployment. If inflation proves sticky or unemployment ticks up, no amount of short-term technical momentum can save a high-yield fund from a genuine recession.
So what does this all mean for you listening right now? It means understanding that a 6.68% yield is fantastic, but only if the underlying asset doesn't bleed value faster than it pays you out.
Right.
You aren't just buying a monthly dividend check. You're buying a tiny slice of the economic health of 1,300 lower-rated corporations in a world where inflation is a wild card.
Which raises an incredibly important cliffhanger question for you to mull over. Let's say inflation suddenly rears its head again, aggressively eroding fixed income returns. Will the sheer diversification of 1,300 different bonds be enough of a structural safety net to protect your capital?
Or is the mathematical allure of a high monthly yield just a comfortable illusion, masking the risk of a market trap? That is the question you need to explore on your own.
It separates the pros from the yield chasers.
It really does. Thank you all for joining us on this deep dive. Please do not forget to like the video, subscribe to our YouTube channel, and drop your thoughts in the comments section below. We really want to know if you think HYG is undervalued or a trap. Until next time, keep digging.